Hey there, science fans! Today we're diving into the exciting world of monetary policy. Now, I know what you're thinking. Monetary policy sounds complicated, but trust me, it's not as scary as it sounds. In simple terms, monetary policy is how a country manages its money supply to influence its economy. Think of it like adjusting the thermostat in your house. If it gets too hot, you turn the temperature down. If it's too cold, you crank it up. Monetary policy works in a similar way. If the economy is growing too slowly, the government can use monetary policy to try to stimulate growth. This might involve lowering interest rates to encourage people to borrow and spend more money. On the other hand, if the economy is overheating and inflation is a concern, the government can use monetary policy to try to cool things down. This might involve raising interest rates to discourage borrowing and spending. But who controls this powerful thermostat, you ask? In the United States, it's the Federal Reserve, also known as the Fed. The Fed is like the economy's personal banker. It sets interest rates, lends money to banks, and generally tries to keep the financial system running smoothly. The Fed's decisions have a huge impact on our daily lives, influencing everything from the interest rates we pay on our mortgages to the prices we see at the grocery store. Now, let's talk about interest rates. What are they, and how do they work their magic on the economy? Imagine you want to buy a brand new bicycle, but you don't have enough money saved up. You could borrow money from a bank, but they'll charge you interest on that loan. Interest is basically the price you pay for borrowing money. The higher the interest rate, the more expensive it is to borrow money. The Fed has a few key interest rates that it can adjust. One of the most important is the federal funds rate. This is the interest rate that banks charge each other for overnight loans. When the Fed lowers the federal funds rate, it becomes cheaper for banks to borrow money, which means they can then offer lower interest rates to their customers. This can encourage people to take out loans for things like cars, houses, and business investments. But what happens when the economy starts to overheat? Remember, just like that thermostat, we need to cool things down a bit. That's when the Fed might decide to raise interest rates. This makes it more expensive to borrow money, which can slow down spending and keep inflation in check. Think of it like putting on the brakes when the economy is going too fast. Now, let's shift gears and talk about fiscal policy. Unlike monetary policy, which is controlled by the Fed, fiscal policy is determined by the government. It involves decisions about government spending and taxes. Just like monetary policy, fiscal policy can be used to influence the economy. When the government spends more money on things like infrastructure projects or education, it can create jobs and boost economic growth. This is because that government spending goes right back into the economy as people get paid for their work and then use that money to buy goods and services. On the other hand, when the government raises taxes, people have less money to spend and invest, which can slow down the economy. Of course, finding the right balance between spending and taxation is crucial. If the government spends too much without raising enough revenue through taxes, it can lead to budget deficits and potentially inflation. Conversely, if the government cuts spending or raises taxes too much during an economic downturn, it can make the situation worse. It's all about finding that sweet spot. So, we've learned about monetary policy, controlled by the Fed, and fiscal policy, controlled by the government. But how do these two forces work together to keep the economy humming along? Well, imagine them as two teammates working towards a common goal, a stable and prosperous economy. When the economy is facing a recession, the Fed and the government can team up to stimulate growth. The Fed might lower interest rates to encourage borrowing and spending, while the government might increase spending on infrastructure projects to create jobs. This 1-2 punch can help get the economy back on track. Conversely, if inflation is a concern, the Fed might raise interest rates to cool down the economy while the government might reduce spending or raise taxes to curb demand. By coordinating their efforts, the Fed and the government can help keep the economy on an even keel, avoiding the extremes of runaway inflation or deep recessions. Remember, understanding how monetary and fiscal policy work is essential for anyone who wants to be an informed citizen. These policies affect our daily lives in countless ways, so it's important to stay informed and engaged in the conversation. And that's our show for today. Keep those brains buzzing, science fans!